Okay, let's get started. Good morning. How's everybody? Good. All right, we're marching toward the very last two chapters. We have a little bit of chapter 12 on preferred stock, and then we'll move on to chapter 13. Chapter 13, relatively compared to other chapters, is about just half of the size. Okay, so we're going to finish chapter 13 this week, and then start, for the most part, of chapter 14 also. Okay, so we're marching toward the last two chapters. We have a little bit left of chapter 12. We started 12 on understanding more on balance sheet, specifically stockholders' equity section. If you remember, balance sheet breaks down to assets, liability, equity. Equity, by definition, is net worth of the business, and it breaks down to the part that earnings company actually earned by themselves by providing goods, services, which later produces into net income and factors in retained earnings. So this part is internally generated fund. There's another side of equity, externally generated fund, by issuing common stock, preferred stock, and also today on Wednesday we'll cover treasury stock. Later on, perhaps companies may also buy back some of the stock. Okay, now with part two, common stock and preferred stock, sometimes companies may decide to reward shareholders for the external capital that they provided for the business. So this is the thing that we call dividends. Dividends is like a gift to shareholders based on companies' operations. They may decide to give out dividends, they may not. So this is a call for the board of directors. But if they do decide to give out dividends, there's two entries to this. Okay, first is declaration entry. Remember, it usually starts somewhere close to the end of the season, but not exactly the very last week. So oftentimes 3 to 4 weeks before dividends is actually paid out. So last week we talked about dividends. When we declare dividends, we would journalize reduction of retained earnings and then also dividends payable. Okay, you also have a homework assignment on this concept. Dividends payable, retained earnings is being reduced because this is a gift to shareholders. It reduces what we eat up, what we accumulated earlier. Okay, but when it comes to payment, so that is a declaration entry. When it comes to payment, we'll be reversing dividends payable and then paying cash. Okay, so this part here is cash dividends. Today we'll also be going into a topic on stock dividends. Cash dividend, basically that means the gift is cash itself. Later on, if you and I are shareholders, we'll be receiving checks from company. That is the idea of cash dividend. Okay, today we'll go into another topic, stock dividend. Basically, the gift is not cash, but other stocks issued by the company. Okay, now for cash dividend, when we want to divide cash dividends between preferred shareholders and common shareholders, this is the way how we divide it. Okay, and then preferred shareholders also breaks down to two types. If it's cumulative preferred shareholders and non-cumulative preferred shareholders. Okay, so this is an example that companies issued either $5,000 or $50,000. Now remember that dividends is calculated based on percentages of face value. Okay, so percentages of face value, if we look at this example, it tells you a company has 2,000 shares of $50. This is a preferred stock. Face value is 50. Altogether, they issued out 2,000 shares. The dividends rate is 6%. So to calculate the total amount of dividends that preferred shareholders is entitled to get, that will be 2,000 shares times the face value of each share times the rate of dividends. So altogether, this will give you the dollar amount, $6,000. This is the part that preferred shareholders is supposed to get every year as long as company declared out dividends. Okay, now remember I talked about a case of cumulative and non-cumulative. For the most part, preferred shares are cumulative. Okay, then the homework problem that they gave you, there's one problem that breaks down to cumulative and non-cumulative, just so you have a sense of how it works for both cases. But in the real world, usually preferred shares are actually cumulative, meaning that the dividends that they did not receive this year will carry on to the following year. They have the right to receive the difference that they did not get this year. Okay, for example, the upper example here, case A, total dividends amount is $5,000. Remember, preferred shareholders, they are they're supposed to get $6,000. So the differences between this and what the company actually gave out, the $1,000, will be added to next year. Okay, so meaning next year, if, let's say, company this following year has a better operation compared to last year, if they gave out $8,000 of dividends, then again, preferred shareholders will be getting $6,000 plus the missing $1,000 part that they did not get in the previous year. Okay, so cumulative means that the dividends amount for preferred shareholders will be added on to the following years if they didn't receive the full amount in the previous year. Right, so the upper example here, you see preferred shareholders, they get $5,000 in full because this is the total amount that company is able to declare out to their shareholders. And since this is even less than what preferred shareholders is supposed to get, then common shareholders will be receiving 0 in this case. Okay, we always consider what preferred shareholders will be receiving first, and then whatever is left goes into common shareholders' hands. Okay, so in the following case is an opposite example. If company this year, they're doing pretty well, they got a lot more than they expected, and now they're issuing out $50,000 of dividends. In this case, since $50,000 is a lot more than $6,000, obviously, whatever preferred shareholders is receiving, there's going to be leftovers from that. So altogether, the leftovers will fall into common shareholders' hands. Okay, so these are two independent cases, giving you an example of in case dividends are even less than what preferred shareholders is supposed to get, then all of it goes into preferred shareholders' hands, and that $1,000, the missing $1,000 between $5,000 and $6,000 will carry on to the following year. So next year, preferred shareholders will be getting, they are entitled to get $7,000 instead. Okay, now this is an example that companies issued out a lot more than what preferred shareholders is able to get. So in this case, common shareholders also gets dividends. Okay, so companies, they always consider preferred shareholders dividends first, and then if there's anything left, that goes into common shareholders' hands. Okay, so this is a cumulative case. If there's missing amount this year that they didn't get, it will carry on to next year. In case the preferred shares, the problem specified as non-cumulative, then that basically means after the first case, preferred shareholders this year, they only get $5,000. Next year, that missing $1,000 doesn't carry on. Okay, so it's just the opposite of a cumulative case. So next year starts fresh again. Preferred shareholders is still only entitled to get $6,000 rather than $7,000. Okay, so this is non-cumulative, this is cumulative. Next year, one of them gets $7,000. They have the right to get $7,000. Otherwise, they would just still be getting $6,000 of whatever the company declares. Okay, any questions to dividing dividends? This is very important. Okay, this idea of dividends, how to divide between preferred shares and common shares is very important. Okay, so the part that this basically summarizes what I just talked about, cumulative preferred shares, non-cumulative preferred stock. The non-cumulative part, dividends not paid in prior years, do not carry on to following year. It doesn't accumulate. Okay, as opposed to that, for the most cases, preferred shares, anything that they didn't get this year, that company didn't declare, reaches the amount that they are supposed to get in this year. That part will carry on to following year. And the missing part is what we call, sometimes in the problems you will see, dividends in arrears. Okay, the dividends in arrears, passing dividends, that basically means that difference that they didn't get. Okay, so that $1,000 will be the dividends in arrears. Next year, preferred shareholders will be getting $7,000 instead. Okay, so cumulative preferred shareholders, they must receive all the dividends that they did not get from previous years that was accumulated before common shareholders' right is considered at all. Okay, so this is part of the benefits for purchasing preferred stock. Usually the face value is higher for preferred shareholders. When they purchase each share, oftentimes it's about 10 times or even more. The value that they need to provide to company is a lot a lot of times for each share is a lot higher than common shares. Okay, so the right they receive, this is part of it. Dividends, they will be considered first, and if the company goes out of business, liquidation value of assets, they also receive first, and then common shareholders' right is considered. Okay, so these are the benefits to preferred shares. Okay, now for all the problems, unless you see non-cumulative stated, otherwise you can just assume all the preferred shares are cumulative, meaning the dividends carries on. Okay, unless it specifies that it's not. Otherwise, usually the case is cumulative preferred shares. Okay, let's move on to take a look at an example. Assuming that again a company declares $50,000 of dividends, same example that preferred shareholders is still entitled to get $6,000 every single year. It tells you that this company has dividends in arrears for 1 year. That basically means last year they didn't give out any dividends. So there is an accumulated amount of dividends from last year that will be carried on to this year. That is what the first bullet point, dividends in arrear for 1 year means. Okay, it carries on to this year. So now for this year, a company's preferred shareholders will be entitled to get not just $6,000, but $12,000 instead, because last year they got zero. Okay, so the journal entry here to declare the dividends will be reducing $50,000. This is given to you. The problem tells you we're declaring $50,000. $12,000 goes to preferred shareholders' hands, and then anything that's left over, the remaining goes into common shareholders' hands. Okay, so this part on a yearly basis is supposed to be $6,000 only, but because last year the problem tells you company didn't declare anything, so it carries on to this year. Altogether, they're getting $12,000. And again, the calculation is based on the dollar amount of each share times the number of shares out there in total times the dividends rate. Okay, so it's actually very similar to the idea of interest, except that here what we call we're considering the reward to shareholders, so it's considered dividends. It's not a responsibility to give them every single year. Depends on company's operation. Okay, so the 6% there is the dividend rate. Okay, let's work on this problem together. It says this company has 9,000 shares of 4% dividends rate, and each share, the par value is $10, is a cumulative preferred stock. This is the first type of stock they have. The other type they issued out is 47,000 shares of common stock. Okay, so there are two types. And assuming that a company did not declare any dividends in 2011, now this year is 2012, they declared a total dividends amount is 54,000. So this is the total amount of shares, total amount of dividends that they're giving out to shareholders. So this $54,000, how much of dividends goes to common shareholders? If I ask you another question, how much of it goes to preferred shareholders? Okay, this one is on common shares, but try to also calculate preferred shares at the same time. In this problem, since it tells you 2011, there was nothing declared out to shareholders. So 2011, last year, the missing amount for preferred shareholders, we need to account for this first. Then also account for what is this year, what they're supposed to get. And then anything left goes into common shareholders' hands. Okay, this part of the question here actually is always considered the very last step. We always consider preferred shareholders first and think about whether previous year is there anything that needs to carry on to this year. Okay, so preferred shareholders amount would be 9,000 shares times $10 par value times 4% of the dividends rate. Okay, this will give you $3,600. That is every single year is the dollar amount of cash dividends that preferred shareholders is supposed to get. Okay, so they have $3,600 from previous year. They have $3,600 that they are entitled to get this year. Add them up, that will be the total amount that they're getting in 2012, $7,200. Okay, and this amount is a lot less than in total what they're declaring in this year, $54,000. So the differences will be going into common shareholders' hands. Okay, so the part under 2011 is what we call dividends in arrears. The part that they did not declare last year accumulates to this year. Altogether, they're getting $7,200 this year, and then common shareholders is getting $46,800. Okay, let's work on another problem on journal entries, still on dividends, but in terms of journalizing it. Okay, this company tells you that they are issuing cash dividends, and they have preferred stock 2,300 shares, Each face value is $50. Dividends rate is 5%. We also have common stock, 55,000 shares. And it tells you that per share, the cash dividends is 50 cents for this. Okay, so A journal entry, if we want to declare cash dividends for both of these stocks together in one entry. B entry, if we were to pay the cash dividends, how do you journalize this? Okay, how do we calculate preferred dividends, preferred cash dividends? Where do we start? Okay. 5%, and this will give you 150. What about common? $0.50, it tells you for common shares, each share, they're getting 50 cents. So if I own one share, I'm getting 50 cents. I own two shares, I'm getting $1. So basically you use the 50 cents times the total amount of shares. Total number of shares is 55,000 shares. That will be the common part. Okay, so this problem here doesn't tell you originally what was the total amount, not asking you to divide it. There are two ways to do it. Some of the problems will tell you in the beginning what is the total amount, and you divide the part into preferred shares, and then whatever is left goes into common shares. Another way to do this is companies can just simply state what is the preferred rate for dividends for preferred shareholders, and then what is the flat rate for common shareholders. So this is a case of common shareholders having a specified flat rate. For each share, they're getting 50 cents. Okay, so we just times the number of, the dollar amount of cash dividends they're getting for each share times the total amount of shares. That will give you 27,500 for common cash dividends. And for preferred, the calculation is the same as before. Okay, face value times dividend rate times shares. Now this is a declaration entry. Remember, declaration, we're not yet paying it out. So it's a type of liability incurred temporarily. Okay, later on, 2 to 3 weeks later, it will turn into actual cash payment. We'll be reducing this. Okay, so this part here, we're just reducing retained earnings, increasing dividends payable. And the following entry will be debiting these two, crediting cash for payment entry. Okay, so the payment entry is simply just flipping that dividends payable entry, and since we're paying it out by cash 2 to 3 weeks later, reducing cash by the total amount, $33,250. Okay, and the dollar amount, you could get it by here. So this problem here doesn't tell you whether there's cumulative dividends in arrears from the previous years. If it doesn't tell you, you can assume that there's zero. The problem tells you there's anything that they didn't pay previous years, and you have to add on to what's declared this year. Okay, but that only works for preferred shares. Okay, common shares do not get any cumulative dividends at all. They just get whatever's left for whatever dollar amount is declared up front. Okay, any questions on dividends before we move on to other topics? Okay, let's take a look at the last section of this chapter that we'll cover on return on assets, return on stockholders' equity. So these are two ratios that are very important. Oftentimes, shareholders, creditors, they will be using these to decide whether or not to invest in the business or borrow money to this business. So again, a lot of the ratios are using different aspects to analyze the company from different perspectives. So earlier we talked about inventory. There is also inventory turnover rate. We talked about accounts receivables. We talked about some of the ratios there. Here, this is more of an overview of the company's return net income over how they use the assets, or the return net income over how they have been using the capital that shareholders contributed to the business. So the first ratio here, rate of return on assets, the return basically is referring to what they have generated, meaning the net income and interest that they have gave out to shareholders and creditors together. Okay, so numerator, you can see the numerator part is referring to the return, and then total assets, we measure it by average assets. Whenever you see average assets, that basically means, or average of anything, that's the beginning plus ending divided by 2. Okay, so this ratio, the numerator is the return to shareholders. In general, net income is considered the return to shareholders. Even though they're not getting this, keeping it in their pocket, but because net income on a yearly basis affects stock price as well. So shareholders, if they purchase a few number of shares, that definitely will be affected by how the company is operating. And also dividends later on will be coming from retained earnings. So retained earnings is an accumulation of net income. Okay, so we use net income as a return measure for shareholders, and interest expense, obviously this is the part paid to creditor. So this, if you borrow money to the company, you'll be receiving the return in a form of interest expense. Okay, so interest expense is the return to creditor. Net income, we use it as measuring the return to shareholders in general. Since net income basically represents how the company is operating. The more there is there, that means the company is doing better in terms of internally generating their fund. Remember, net income comes from income statement. Net income comes from, generally speaking, is sales, the revenue minus all the different types of expenses. Okay, so it's their internally generated income based on providing services or providing goods. So we measure the relationship between average return to shareholders and creditors, these two parties, compared to the total amount of assets, the average amount of assets the company has. So this gives us a relationship between how the company has been using these assets to turn into return to these two parties. That's what this ratio is trying to tell us. Again, how the company is using the assets to generate return to shareholders and to creditors. This is what rate of return on total assets means. So here's an example, assuming that beginning of this year, the total assets shown on balance sheet altogether, including current asset, long-term assets, all different kinds that we talked about in chapter 8 and 9, assuming altogether the value is $843 million, beginning of balance sheet, meaning last year end. And assuming this year end, Altogether, we have $822 million of total assets. Okay, so these two, average them out, we add them together, divided by 2. This will give you the average total assets value. And we compare this against the total return that we got. So the return, again, we pull from income statement. There's $33 million of net income and $22 million of interest that you gave to shareholders, gave to creditors. Okay, so $33 million is the net income, $22 million is interest that you give to creditors, either short-term notes payable creditor, long-term notes payable, bondholders. Altogether, interest is $22 million. Okay, so this ratio at the end will tell you per dollar of total assets how much return is generated. So this 0.06 means for every dollar of total assets invested in the company, it turns into 0.06 of return of net income plus interest on average. Now this ratio, since it's a return ratio, the numerator is net income, the larger the better. Always, if you compare across the years, if it's increasing, that's a better sign. Decreasing, that's a bad sign. But we do have a rule of thumb to this. Okay, about 10% rate of return on assets is considered, generally speaking, good. Okay, of course, different industry may have a slightly different rate, but on average, we would say 10%, meaning if every dollar of total assets turns into 0.1 dollar, then that basically means this ROA is considered pretty strong, above that. Okay, but the higher the better. Okay, so it's net income, dollar amount plus interest expense over average total assets. So beginning plus ending divided by 2 is this part. This is ROA. So the result for this example, is it good or bad? Strong or weak? The result for this is 0.066, which turns into 6.6%, which is lower than the 10% rule of thumb. Okay, so this is an example. This example in this slide is an example of a weak ROA, meaning that the assets that they own is a lot higher than the return that they actually received after a year of providing services, providing goods. So this is a weak ROA. If we want to compare this ratio to the same industry, other companies, if they have 12%, 13%, those are the companies that are doing a better job using their assets. Okay, let's take a look at another one. ROE, rate of return on common stockholders' equity. The numerator almost is very close to ROA. It's almost the same, except that we're subtracting any preferred dividends that we gave out to shareholders. So not each and every company has preferred shares. So some companies do, some companies don't. So in order to be comparable on ROE, oftentimes we just exclude the preferred dividends part. And we also do not consider preferred shares in this ratio. So this ratio is purely about common stockholders' equity. Usually common stockholders' equity is the majority part compared to preferred shares. Preferred shares usually is a lot less than this. Okay, and keep in mind that each and every public traded companies would have common shares, but not necessarily preferred shares. Okay, so this rate of return, we're comparing the return again to common shareholders. That's why we use again net income. Remember in the previous ratio, net income is also representing return to shareholders. For this part here, we subtract any preferred dividends. Earlier we were calculating, remember the $6,000? We subtract that part, preferred dividends. So the numerator is the return to specifically common shareholders, and the denominator here is average common stockholders' equity. Again, you see the term average. So you would compare beginning, meaning last year end's beginning balance sheet equity on common stock, and then this year ending common stock equity amount. Then add them together, divided by 2. Okay, so following previous year's example, we still have 33 million net income amount. And assuming preferred dividends is $6 million, we subtract it, divided by average level of common stock equity. So what this means is we're trying to understand the relationship between the return that we gave out to shareholders compared to what they contributed to the company. This part here is the contributed capital from shareholders. Okay, so the average dollar of contributed capital to shareholders, how much of it actually turns into the return to them. Now the rule of thumb for this ratio is about 15% and higher. Again, the higher the better, because numerator is the return amount. So just like ROA, the higher the better. If you compare across the industry, compare across the same years, the different years in the same company, 15% and above will be considered using the contributed capital pretty well. So again, if we use this measure to evaluate this example, is strong or weak? Weak, right? Because this example, again, $1 of common shares contributed capital, it only turns into about $0.09. So it's relatively speaking, this is a 9% rate of return on equity. It's lower than the rule of thumb, 15%. Okay, so this is ROA. Then ROE, we have an income minus preferred dividends divided by average common stock equity. Okay, let's do an example on these two ratios. So you have the balance sheet and you have an income statement. Income statement you can pull net income amount from, and also, well, you just need net income amount here. For balance sheet, you have 2 years of balance sheet because we need the beginning and the ending. Okay, so as of 2012, try to calculate the ROE and ROA based on these information here. Okay, just pull the ones you need for the ratios, the formulas. And then try to evaluate whether it's strong or weak for the company this year. Which dollar amount that you can't see? Or all of them?
No.
Let me know which one if you want me to. Okay, how do we get ROA here? Numerator. We start from, okay, and then we would add the interest expense, which is 210, yes, and then average total assets, that would be, okay, and then plus whatever is there last year, right? So what is your ratio to this? 4,000. Okay, I'm going to click and see if you got it right. So I think it's the run. So 3,890 plus 210. This together, upper part will give you the dollar amount of 4,100, right? And then divided by this. So 13% is rate of return on assets, meaning per dollar of average investment in the asset, it turns into $0.13 of the return to shareholders and creditors on average. Okay, so remember the rule of thumb here, 13% is above the rule of thumb 10%, so relatively speaking it's considered strong. Okay, now for ROE, if we match again with the information here for ROE, we have again net income amount, and then the upper part we consider, since the problem doesn't tell you any preferred dividends, you can assume that there's zero. So in case there is preferred dividends, you have to subtract it. Now the upper part, common shareholders equity, just add those two numbers together divided by 2. Okay, so that'll give you 25.1%. Again, this is above the 15% rule of thumb for ROE. So both of them here is considered pretty high. It's considered strong ratios in terms of how company has been using their assets, how companies have been using their contributed capital from shareholders. Any questions for these ratios? Basically, these two in summary is an overall view of how companies has been operating, because now the numerator here is net income, which is this entire year's operation profitability. So we want to compare this profitability against the total assets that we have purchased earlier, because if you just look at net income dollar amount, you can't tell whether the business is doing better or not. If this company has $1 million of asset, it turns into only $1,000 net income, compared to another company that has only $10,000 of asset and turns into the same $1,000. We want to be able to compare these different industries since they have different amount of assets. Or another case, if a company has, again, 1 million common stock, their return is still 1,000. If a company has only 10,000 common stock equity, their return is 1,000, then obviously the latter case would have a higher ROE. Okay, we want to use this ratio to evaluate overall profitability of a business compared across industry, compared across the same company. So if the rate is higher every single year, then that basically means they're growing in terms of how they're using their assets, how they're using the equity compared that's contributed to their business. Okay, so just keep in mind the rule of thumb. After you calculate this, to evaluate it, one is 10%, one is 15%. Okay, that's all for chapter 12. We're going to move on to, let's take a look at this example first, and then we'll move on to chapter 13. Here's an example that looks at the entire equity section. I want to bring this up because we haven't talked about any problems that look at both sides, paid-in capital and retained earnings. So here it tells you that there's 8,000 shares of $2 par value common stock, and then there's also $50 outstanding. The original issue price for the stock is $15. Now it tells you there's a deficit balance of retained earnings. Remember we talked about this last week. Deficit balance is a negative balance of retained earnings. Sometimes it happens in the beginning of the company when they haven't started generating net income yet. All along they had was net loss. So it tells you the net loss total amount is $86,000. So if I ask you to complete just the stockholders' equity section for this problem, it would look like this. You would have common stock, 8,000 times 2, which is the par value amount. Then you have paid-in capital in excess of par value, $104,000. And then retained earnings has a negative balance, so is a deduction account for the entire equity section. Okay, meaning on the balance sheet, there's asset, liability. This is what the equity section will look like. The equity section breaks down to two parts: paid-in capital, externally raised fund, and internally generated. It tells you up to this point they haven't generated net income yet. So this is a total amount of net loss. That's why it has a negative balance. Okay, on the upper part is the total amount of stock that they issued. Altogether, they issued 8,000 shares. The original issue price is $15. Face value is $2. So the difference is the excessive, like the premium of stock, $13 per share. Okay, so you will have three categories under stockholders' equity. Two of them under paid-in capital. One is retained earnings. The 104,000. That's the premium for, the 120, yes, this is add them up, add the two. Because we're calculating the total equity, so upper part, this is the contributed capital, this is the negative balance of retained earnings. Okay, generally speaking, later on, once the company starts generating net income, if this part is positive, usually it's positive, for most cases you see here, then we would add paid-in capital and retained earnings. But this is a problem that tells you it's a deficit balance, meaning they haven't generated net income yet, so we subtract it. Okay, chapter 13, we're still on the topic on corporations' equity section. We just have a few more topics to go on. Still related to stock, in terms of splitting the stock, giving out stock as a gift, or buying back the stock. How do we journalize these transactions? Okay, at the end I'll be showing you a complete corporate income statement with also earnings per share information. Okay, so net income is not the end of income statement. Actually, there's following information, just a few sections more in some of the cases introduced in this chapter. Okay, stock dividends, just like cash dividends, the idea is the same. It's still a reward to shareholders, just in a different form. Okay, sometimes companies issue stock dividends rather than cash dividends in order to, of course, keep some of the cash for themselves. If they want to, they have further investment projects that's coming up. Probably they don't want to use up their cash immediately. But if they still want to reward shareholders for the contributed capital that they gave to the business, oftentimes they may change the form into issuing stock to them instead of giving cash immediately directly to shareholders. Okay, so there are several motivations behind this to keep the cash themselves. Of course, to reward shareholders, this is definitely part of the motivation. Other times, they may want to also reduce the current market price for shares by giving away more shares, issuing more shares to the public. Okay, so this is similar to the idea of, I'm sure pretty much in the economics courses you may be talking about, the more supply there is out there, oftentimes the price will decrease. The less supply there is out there, oftentimes the price will increase. Okay, once there's a lot of the supplies of the same things, oftentimes there are more people that will be available to get it, the price will lower down. This is also similar to how stock market will work for these cases. Okay, stock dividends, once there's issued out to the public, that basically means if earlier, let's say there was 1,000 shares out there, company decides to give out shareholders stock dividends additional 100 as a gift to them. Then altogether there's no longer 1,000, but now there's 1,100 shares out there. This oftentimes will trigger the market price to go down a little bit for the shares outstanding. Okay, so reduced market price per share sometimes is also the motivation to this. So this is just some of the background story for you to know. You don't have to memorize these. Just understand, again, our main focus is how to journalize them, okay, how to represent them on financial statements. So stock dividends, it decreases retained earnings just like cash dividends. Remember, when we issue cash dividends, we will be debiting retained earnings, crediting dividends payable, and later eventually crediting cash. So here, stock dividends at the same time also reduces retained earnings, but under the right side, we're not reducing cash, but we're giving stock instead. Okay, the right side will be common stock, and if the right side common stock, again, the issue price currently is different from par value, then there's also paid-in capital in excess of par. So it's almost the same entry as how we issue a regular stock to the public, except that now the stock is not collecting cash from the public, we're actually giving away as a gift to shareholders. So we're using up the company's own retained earnings to issue the stock. Okay, so stock dividend basically is just rearranging the stockholders' equity section, reducing retained earnings, increasing paid-in capital section. It's a gift to shareholders. So an example here, if let's say the company issues 10% of stock dividend, that means they're issuing 10% of what's out there, proportion to the stock that's outstanding. So meaning if currently there's 1,000 shares out there, if they're issuing 10% of stock dividend, that means they're issuing 10% of this. They're issuing an additional 100 shares. Okay, if there's total 1,100 shares out there, they're issuing 10%. They're issuing an additional 110 shares to shareholders. Okay, so the percentage is just percentages of the original outstanding shares. So after giving out stock dividend as a reward to shareholders, the number of shares issued is increased. Total outstanding shares also is increased. So that's why earlier I was talking about it might likely reduce the market price for stock because there's more supplies out there. Okay, so this is just some of the background and theory to this, and now I'll go into the journal entries. Yes, 13. The 12, we talked about cash dividends. Here we're talking about stock dividends. Okay, both of them are rewards to shareholders. However, cash dividends, it reduces cash, which is asset. Stock dividend reduces retained earnings. Okay, we're in the company's perspective, we're not issuing the stock to collect cash from customer or from shareholders. We are issuing the stock using up our own retained earnings. So it's kind of just rearranging our own stockholders' equity. Overall, total equity is still the same. Okay, we're reducing our retained earnings and giving away common stock to shareholders. Okay, let's take a look at how the journal entries would seem. Again, just like dividends, cash dividends, there are 3 dates to this: declaration date, and also date of record, and then payment date. So again, for date of record, we don't do anything, and for stock dividends, declaration date, we also don't do anything. Okay, so for stock dividends, it's actually relatively easier. We only have 1 entry, distribution date. We would journalize this. Okay, so you see the left side is the same as cash dividend. We reduce retained earnings. Right side, it's not dividends payable, but it's directly common stock, because this is a thing that's going out to shareholders' hands. Okay, meaning after this journal entry, if you are the shareholder, I'm the company board of directors that's giving away this, you'll be receiving common shares after this. So the common shares, you can also sell it to the market to get cash back, or you can keep it later on if the market price goes up, and then later on sell it. So it's really up to shareholders what to do with this reward. So it's not a cash immediately, but you can also sell it to the market to get cash back. It's up to shareholders. Okay, so this is an example that company is issuing 2 million shares out there. Company has readily issued 2 million shares, and now they're company are issuing 2 million shares to the shareholders as a dividend to them, and the par value is $1. Earlier, that's the part outstanding, and this 5% is the additional dividends that they're giving to shareholders now as a gift. So it's 5% of the 2 million shares that they earlier issued, that's earlier out there. So you see this part here, 2 million times 5% is the stock dividend rate. $1 is the par value. Now the upper part that I underlined there, $50 market value, is the current market price that's trading. So the difference is 49, goes into paid-in capital in excess of par. Again, this is a premium account for issuing stock. So whenever a company issues stock, regardless of whether it's directly collecting cash or as a gift to shareholder, we always consider the differences between market price and par value. The difference is the premium goes into paid-in capital in excess of par. So this is a case for small stock dividend. Whenever companies give out dividends, there's 2 cases: small stock dividend and large stock dividend. Generally speaking, any percentage of stock that we give out below 20% or 25%, you usually won't see any dollar amount between the 2. Company either has a cutoff point below 20% or below 25%. They're all considered small stock percentage of dividends. Okay, so for small stock dividends case, we would compare the differences between market price and face value, consider premium for this case. Well, for large stock, we have a different approach. Okay, so again, for this small stock dividend case, there originally was 2 million shares outstanding. We're issuing 5% of stock dividend, 5% of the original issued number. So 5% is considered lower than 20%. We consider small stock dividend. We would consider any premium in this case, market price, the differences between market price and face value. Under the case of large stock dividend, left-hand side is still retained earnings. Right-hand side, we don't consider any premium for large stock dividend. Okay, large stock dividend, any additional gift of stock gave to shareholders above 20%, 20 to 25% bracket above this dollar amount. If you see the stock dividend is 30% or 40%, it's considered large stock dividend. So in this case, the 50% times 2 million shares, or 100,000 shares in this case, times the face value would altogether be recorded under retained earnings and common stock. So if you compare this journal entry with the earlier one, we don't consider a premium for large stock dividend case. The reason why this is because, again, going back to earlier, the motivation, if there's more stock out there, this large stock dividend case, meaning that companies is issuing 50% of what they originally had, meaning 1,000 shares. If you issue 50%, that means we're issuing 500 more shares. So this significant number of shares out there were likely to reduce the market price a lot more than compared to small stock dividend case. Okay, so in this case here, we don't know where the market price will be. It often and very likely will reduce to a very low price later on after this entry. So we just use the par value and we don't consider market value at all. Okay, so earlier we were considering $50 of market value when we issue small stock. For large stock, we just use whatever is the par value because we don't know later on whether market price will be significantly below a certain amount. It's very hard to measure. Okay, because this is a significant number of stock dividend gave out to shareholders. Okay, so market value is used for small stock dividend, par value is used for large stock dividend. If we report both cases under balance sheets, the first balance sheet here shows equity after 5% of common stock dividend. So this part here, the common stock case, you see an additional 100,000 shares issued. So there's authorized is 20 million shares, and now the number of shares issued is 2,100,000 shares. Okay, after the 5% common stock, meaning if we post the information to T accounts and then post it here under balance sheet, this part shows the small stock part. Okay, the upper balance sheet. So below one here shows both cases. After both entries, small stock dividend and large stock dividends, you can see that retained earnings reduced compared to the upper case. So again, any stock dividends gave out to shareholders really is just rearranging stockholders' equity section. See, the total number of stockholders' equity section is the same, but the only difference is that retained earnings reduced here and then turns into common stock equity section. So the total paid-in capital is about $27 million, but if you look at above, it's only about 26. This part here, if company issued again 50% additional common stock, a part of retained earnings again will be used up and then will be used to issue common stock. So you see this part here, common stock increased. Okay, it's a rearrangement of common stock, rearrangement of retained earnings. We're using retained earnings to issue common stock. This case, we use retained earnings twice to issue 5% of common stock and additional 50% for both of the entries that happened before, this one and this one. Okay, so if we represent both cases here, you see the total amount of paid-in capital and retained earnings altogether. Stockholders' equity is the same for both cases. It's just a rearrangement of retained earnings into common stock. Okay, this is very important to know because cash dividends is different. Cash dividends, we use retained earnings, we use cash, assets. Stock dividends, we use retained earnings, we issue common stock to shareholders. This part reduced, this part increased. The total amount of capital would not change under a stock dividends case. Any questions so far? Okay, let's work on an exercise here on the concepts for stock dividends and cash dividends. You can either answer cash dividends, stock dividends, or both of them. For A, which of them decreases retained earnings? Cash dividends, and is that all? Is it both? So for cash dividends, definitely we will debit retained earnings, credit dividends payable, and later debit dividends payable, credit cash. What about stock dividends? What do we debit? Also retained earnings. So in this case, it will be both. Stock dividends, cash dividends, both decreases retained earnings at the end. Okay, which one has no effect on liability? Stock dividends has no effect on liability. Very good. For cash dividends, when we declare it, we have dividends payable. Stock dividends, we only have one entry to it when we actually pay it out, pay out the stock, issue the stock to shareholders. So stock dividends is just, again, a rearrangement of equity. We reduce retained earnings, we increase common stock. So there's no effect on liability account or asset account. Okay, what about C? Which one increased paid in capital by the same amount that they decreased retained earnings? It will be stock dividends, exactly. For cash dividends, it doesn't really affect paid in capital. It does reduce retained earnings, but it increases liability and later eventually reduces cash, which is part of asset. Okay, but stock dividends decreases retained earnings, increases paid in capital, common stock. Remember, because the whole point of stock dividend is to give out stock to shareholders, so it increases common stock. Okay, what about D? Decrease both total assets and total stockholders' equity, resulting in a decrease in the size of the company. Which one decreases assets? And specifically, what type of asset? Oh, this one is easy. Cash, exactly. Because cash is part of assets, so only cash dividends, basically you're just giving checks to shareholders. So it reduces asset, and it doesn't affect any other categories besides asset and retained earnings, these two accounts. So eventually it's decreasing the size of the company because you're using retained earnings. Now in terms of stock, really stock dividend doesn't reduce the size of the company. You're using retained earnings, but you're issuing additional common shares to others. Again, the total equity section doesn't change. Okay, it's a rearrangement of equity. So in terms of company, in a way you can think of it as a trickier way to reward shareholders because it doesn't turn into cash unless shareholders sell it back to the market. Okay, but it's still giving ownership to shareholders, so increasing common shares, outstanding shares out there. Okay, I'm going to talk a little bit about treasury stock first, and I'll come back to stock splits on Wednesday. This is relatively easier. Now, treasury stock is the idea of buying back stock. It's the opposite of issuing stock. Okay, sometimes companies, they may want to issue and later issue the stock earlier, and they may want to require a portion of it back to their company later on. It's reversing earlier the issuance action. So this is a practice in corporations. They sometimes do this because either they want to support the company's stock price. So then this is the opposite idea of giving out stock dividends. Stock dividends earlier, you're issuing more to the public, and oftentimes the price will reduce. In terms of buying back the stock, you're pulling some back to the business. So if you're pulling some back out there in the market, there will be less shares. Oftentimes this will boost up the price a little bit. So the effect is kind of the opposite of stock dividends, which is why I want to bring it up now, so as a contrast to stock dividends. So oftentimes this will support company's stock price, will later on, market price will go up slightly after this. Depends on how many shares company buys. Also, buying back the stock, they can buy back the stock and reward their company's own employees. So earlier stock dividends is rewarding shareholders. Treasury stock could be used to reward their company's own employees at the same time. And other reasons to avoid takeover by the other parties, because usually takeovers depends on the proportion of shares that other parties has. So this is more detailed in business laws. You just have to know a general background of this. Okay, and also increasing net assets by buying low their stock, and later on they may also sell back their treasury stock to the market. So just in general, treasury stock is a contra equity account. Treasury stock has an opposite normal balance like compared to common stock, because one is issuance and one is buying it back. Okay, now in terms of the number of shares, the total issued stock earlier minus any treasury stock, the part that you buy back, will equal outstanding stock. Okay, so meaning if earlier there was 1,000 shares issued to the public, let's say a company decides to buy back 100, then right now what's out there is just subtracting what they bought back. 900 shares is currently the shares outstanding. Okay, so you have to understand the idea. The original shares is the issued ones. Buyback is called treasury stock. What's currently out there in the market is called outstanding stock. Okay, so when we buy back the stock, usually we would record it at the price, the current market price. So earlier, if the par value of a stock, let's say the easiest example of $1 par, currently my company wants to buy back 100 shares of these stock, and right now the market price is $5, I will record it at $5 at whatever price that I'm paying right now. This is, in this section, this is called recorded at cost. The cost basically represents the dollar amount that they're paying at the time point that they are buying back the stock. Okay, so the cost is not the par value, not the face value of the stock. It's the price that currently the market is trading for the stock. Okay, so let's take a look at an example of buying back the stock. Company would, let's say they're buying back 1,000 shares of the stock, again at $5. This is the current market price of the stock, and this will be the transaction. You're just like buying any other type of assets, very similar to that. We're using cash and we're debiting treasury stock because this is a contra equity account. So whenever we buy back any dollar amount, will go into the left side. The money that we use, we reduce it by cash, and the total value of the shares, 5,000 shares, we would debit treasury stock. Okay, so in this case, regardless of what the par value is, it could be $1, could be $2, the original face value, or even $3. But when companies buy it back, it's always recorded at the original cost. Okay, $5, if the market price that is, then we will times $5 to the shares. If it's other amounts, then we times $10 or $20. Again, at the time point when they purchase the stock, that will be the dollar amount that they use.